Welcome to Two Guys Whining About Retirement. It's the only show where you're going to get a review on a bottle of wine and some great financial advice along the way. How bad could it be after a bottle of wine, right? I'm Troy Frazier, your host, financial advisor, and joining me today, my co-host, we're going to call him a wine aficionado and a do-it-yourself investor, Bryan Rose.
Thanks, Troy, for the warm welcome. I'm looking forward to another great bottle of wine. Trying to move past DIY to sommelier level. We'll call it novice sommelier. That's the extent of my French.
Is that what it is?
Yeah. Glad to be here. Thanks for having me.
Perfect. I'm glad it wasn't all French because I don't know French, so I'm glad it was English there. So here's what we're going to do. Just to set this up for the folks that are watching out there is... we're going to review a bottle of wine, talk about some finances, give you a little teaser here. We've got this great topic. Well, if I tell you what it is, you're going to be like everybody else. You're just going to shut down and not watch. So maybe I shouldn't tell them what it is first. Because when you say that word, life insurance, everybody goes, life insurance. Oh my gosh, those evil insurance companies. I've got to go. There's no way. We're going to talk about that evil concept of life insurance today. And answer some questions, dispel some myths. I think we have some questions. Actually, clients wrote in and asking questions on this topic and things, so that'll be great. But before we get into that exciting topic of life insurance, we've got this bottle of wine, and as always, we've already corked it, we've poured it, it's breathed a little bit, and so you take it away. Tell us a little bit about this wine.
Yeah, so this is a Josh Cellars Cabernet Family Reserve out of Paso Robles. So it's a 2018. This is in the under $20 category, so $16.99. Our friends over at Total Wine made it, again, an excellent recommendation. So looking forward to it. I've had Josh Cellars before, never this variety, but
okay. So you haven't had this. So you've had the wine, the winery before.
The winery before, but never this particular. Nope. Okay. No, we try and keep it fresh here.
Okay. So we're experiencing it at the same time.
For the first time.
So what are we supposed to be tasting or?
So this one is black cherry, vanilla, and pairs well with steak. Really? So we're looking for a real big red here. Not the gum.
Big red, huh?
Big red.
Right, there we go. All right.
Not bad. Use some time to open up, I think. So why don't we talk about some life insurance?
Okay. Could you go get some steak while I talk about that? Should I go with it? Would that be a great idea?
Yeah, that'd be perfect.
I'm going to make you hungry now.
I'm starving.
That's great.
Ravenous.
They only know the half of that.
I know.
All right. So let's talk about life insurance.
Right.
It's really interesting because life insurance can be so divisive. It's funny because I travel a lot, as you know. I'm in Vegas. I do a lot of training and things with other advisors and stuff there. And, I always get these weird flights on the way home. And, I'll always get somebody that sits next to me that wants to talk to me. Wow. And what I've learned is about 3 minutes into the conversation, they always go, "What do you do?" And I go, and I get I light up like a light bulb. And I get all excited, and I'll say it loud enough so 3 rows around to get me. I go, "I sell life insurance." Nobody wants to talk to me the whole thing. I get to sleep on the way home. I put on my headset.
Yeah, I was going to say that's better than my headphone track. The headphone,
No, I don't have to be rude. I just tell them all of a sudden. They're like, "Oh, okay, nice to meet you."
You call me rude?
No, you don't have to be rude.
Oh, okay. So I should say I sell life insurance.
Yeah, because there's no law against impersonating a life insurance salesman, so you're okay. But you'll get a great flight, nobody will bother you.
Awesome.
It's funny because I see people, and I call it word biased, and I think that any tool should be open and on the table financially or anything to learn about it and educate yourself so you can make an educated decision, not just based on myths or somebody that has some sort of bias towards it. And, as a registered investment advisory firm, as an independent, we really don't care what tools our client, and I shouldn't say don't care, but all tools should be on the table and then eliminated if they don't fit your profile, right? What you need. So we got to design what goal are we trying to achieve, and then find the tool associated with that. And so here's where we get into life insurance. It can be used for one of two ways. we either, what most people know, we pay the least amount we can to get the most amount of death benefit, because we've got kids that if we die, we got to still send them to college or pay off the house, or, take care of our wives, or they take care of them if we pass away, right? So we have to have a death benefit there. Or the other way to use life insurance is we actually take the least amount of death benefit and we put in the most amount of money. We do just the opposite.
Wow.
Because what happens if we use the right life insurance policy, and we use what we call the tax-free green line. If you ever been in any of my seminars and we talk about the indexed annuity, those things, it has an indexing concept. So when the market goes up, you go up. Market goes down, you can't lose any of your money in there, okay?
Yep.
So traditionally, the first way I told you about life insurance, how we buy it to protect our families and things, usually the costs go up over time. And that's why we hate insurance, right? We hate life insurance because those costs keep going up, going up.
Right.
Well, what we do typically if we use it is we design it so the costs go down over time.
How's that possible?
Yeah, isn't it interesting? Yeah, so
that's very interesting.
So what happens if you have the least amount of death benefit, because death benefit's pure cost, right?
Yep. And
And I've got the most amount of money going in. Well, my cash accumulation, so if I've got my own, say, $100,000 in there, and I've got a $500,000 death benefit, I'm paying for $400,000 in life insurance. But as that money grows, because I'm putting in a lot more than what the premium is for the life, then this starts getting closer and closer to my death benefit. So what happens is I'm paying for less and less insurance over time. But now what happens, my money's growing tax-free in life insurance under Section 7702 within the IRS code. TAMRA, DEFRA, there's a lot of things in the 80s that shook life insurance out. You remember a company called, so I'll see if you remember this, and it might date me, E.F. Hutton? When E.F. Hutton talks, everybody listens, right? So E.F. Hutton actually in '79 developed one of the first life insurance policies that were indexed to do this. That were, you put more money in because their actuaries got together and kind of cracked that code. And so what happened is then there was a rush on the banks because people were taking like $500,000, throwing in a life insurance policy and saying, give me $10,000 in death benefit. And it was growing. It was like a cash cow. It was a cash accumulation vehicle. And so then the banks petitioned Congress and was like, whoa, we can't compete. Our CDs can't compete against that. So Congress then came back and said, hey, look, you now have to have X amount of dollars associated with the death benefit that you have. Okay, no problem. It still worked really well, and it was still happening. So the banks went back and cried again to Congress. They came back and said, nope, now you can't do it all at once. You got to fund it over time. So a lot of times what we'll do is we'll fund these. If we got $500,000 we're trying to get in, we'll do $100,000 a year for 5 years and then kind of let it grow. So there's different ways that you can design these. And then the key is you don't want to touch it really for about 10 to 12 years. And then after that 10 to 12 years, we can start taking guaranteed income. I have one of these personally that I put money into every month. And over the last, 10 to 15 years, we've averaged a little over 8% with no loss inside of there. So no big loss in 2008, any of that.
So it's
and then our cost keeps
risk-free?
going down. Relatively, right? Okay. You still got the insurance company, you want a good insurance company, the Texas State Guarantee Fund, you got all those things you got to look at. But there's a lot of regulations around insurance companies and those things with how they invest their money. They've got to have a reserve account there for every dollar they owe you. So you want a good solvency company in those things.
So let me ask you, is it really a good investment for, for retired individuals or people?
So I hate to use the word investment with life insurance. Okay. It's more of a cash accumulation vehicle is what we use it for. And so, I consider like a stock market an investment, right? Where I got risk in those things, where I got a prospectus to something. This does not have a prospectus. It's like your CD at the bank. It's just how life insurance works under the IRS guidelines and codes. And so is it good at an older age to put your money into it? It depends, right? As anything would, because here's the thing. As long as we can keep the cost And we always disclose the cost of this. A lot of people hide that. We disclose as long as we can keep the cost below what normal money management is. For all of the great features we get, the tax-free growth benefits, we can borrow against it. There's no age rules. It leaves a tax-free death benefit to our heirs when we're gone. It really gives us total control of our money, and we keep that under normal money management guidelines, maybe 1.5% or more over time. Yeah, I think it's a great ad for tax mitigation, income generation, tax-free growth, those things.
Now, is that something, like, can I sell my policy? Like, I'm alive, but I need some cash quickly. Is there a way to sell that?
Yeah, there's a market for that. So if you've got these older policies, I've got one in right now where we're looking at trying to sell it. It's a $200,000 policy. They just don't want to make payments on it anymore. They've got some health issues. Yep. Now, look, you're going to get 10 cents on the dollar. You know, I mean, you're not going to get, it's not like, it's not like, hey, I got $100,000 cash value in this. They're not going to give you $100,000 for it, right? They're going to give you half of that, or 50 cents on the dollar, 40 cents on the dollar, something like that. Yep. But there definitely is a market if you've got a policy that you probably could go out there and sell it in some cases.
Now, can I, like you mentioned, like some of the features of life insurance. What about generating income?
Yeah, that's what I've got mine set up to do. So I put about $1,500 a month into mine. Like I said, over the last 10 years, these policies have averaged a little over 8%. By the time I get into my 70s, I've got about $100,000 a year tax-free that'll come from this. Two of my twins for some of my clients, I just designed a case. They're 28 years old, $12,000 a year they're putting into their policy, $1,000 a month. By the time they retire at age 60, 65, they're going to have about $150,000 a year tax-free for the rest of their lives in retirement. Mm-hmm. So we do. Now, along the line, if they need to get into there and kids got to go to college or this or that, they can borrow from that policy tax-free. There's no 59.5 rules like IRAs and those things. Those go out the window. And so it can be used very effectively as the family bank and borrow against it and replace it.
Interesting.
Yeah.
New information for me. So what kind of insurance, we've talked about it for retired individuals. What kind is the best for retired individuals? Like term versus whole? I'm a little foggy on that.
Well, that's going to be dependent upon whether you're looking for a cash accumulation vehicle or you truly have a need for death benefit. Mm-hmm. Some, as we get older, I mean, think about this. We've talked about this in other shows where spouses get out there. We just talked about this in our Social Security one that we did, is we get out there, one spouse dies, we lose one of the Social Securities, and we double our tax bracket because now we're filing single, not married. A lot of planners miss that. So what happens is either we can use life insurance where we now have the covered party that died, we've got on them, so now we got enough money to replace the income for Social Security that we lost, and it's going to be tax-free, right? Because that death benefit is tax-free. Or let's say it wasn't on the spouse that died, but the life insurance is on the spouse that's alive. We now can go in and turn on the income and start borrowing the cash value from that policy tax-free and replace that. And it's not going to be taxable. So it's going to help us both with the income replacement and the taxation issue.
Interesting.
So there's ways to use that real effectively in that scenario.
So you mentioned a couple scenarios where there's spouses and beneficiaries. What if I don't have any beneficiaries?
Well, here again, this is not a one-size-fits-all, and it may not be right for you. But if you've got... I'm working with a client right now that doesn't have any beneficiaries, but they're not quite to 72 yet, where their required minimum distributions are going to come out. We got about 6 years. And they've got a large IRA that's going to cause them a lot of taxation at 72. Mm-hmm. Well, we're starting to do conversions of that. Instead of doing it into Roth, we're putting it into the life insurance. Oh, interesting. We're getting some long-term care in the life insurance along for the ride, bang for the buck. They're now got a big savings account, basically, that's tax-free, that's growing tax-free, that's safe from the market, but it's getting market rate returns. They're not going to get that in the bank. Right. Okay? So now they don't need the life insurance. We haven't bought it for life insurance. We bought it for the cash accumulation and the tax advantages and the long-term care.
Yep.
So now what happens is we're going to get that all converted. So when they turn 72, they're not going to be taxed on money they don't need or want. And they're going to have this huge tax-free savings over here that they can borrow from or take from. And then if long-term care comes in, they now, because they don't have anybody to come in and take care of them.
Yep.
So they don't have family. They don't have any of that. They want to stay at home as long as they can. They don't want to go in a facility. And so now they're going to have long-term care, which is basically an advancement of that death benefit,
Right.
Up to $250,000 a year that's going to pay for somebody to come into their home and take care of them.
Wow, I mean, this all sounds so great, but it's still like just a part of your plan, right? It doesn't. It sounds
right.
so great, let's make it my whole plan. That's not the right thing.
It's a
to
piece.
Just a piece. Okay.
It's a piece of the plan. But yeah, you've just got to educate yourself. We actually have a whole webinar out
perfect.
there where I have the head of our life team that goes on that. If you send me an email and just say life insurance, and my email's right here on the screen, and just say life insurance webinar or life insurance,
Yep.
I'll send you out a link to that webinar, and you can get on there and take a look. And then after the webinar, there's an opportunity to come back to our Fearless Retirement Roadmap and actually have a consultation, no obligation to actually go over that. But it's a good place a lot of times if you don't know what to do with your required minimum distributions, you're decently healthy, that's a great place to put it. It's going to help the heirs with taxation, all of those things.
Sure. And you keep talking about tax-free. How does that work? I would assume that, where I'm taught that income is taxable, in general. Like, how do we avoid taxes with life insurance?
Well, it's inherently in how life insurance works under the tax code. If you fund it correctly,
Okay.
you jump through all those hoops that were laid out back in the mid-'80s.
Okay.
I don't want to get too technical. It's what's called the corridor, but as long as we do that, we can actually get it all out tax-free.
So you're going to be my life insurance Sherpa. You're going to guide me through this.
That's right.
Help me avoid all the pitfalls.
That's right, because there's good and there's bad, and like sometimes we get into it and we run it, and while the benefits may look good, once we actually get the health evaluation and we get the stuff back from the company,
Great.
we go, hey, the costs are just too much, we can't do it. And then 80% of the time, the costs are totally in line, and it's a slam dunk, and it's a great way to do planning. I mean, that's why I included my own plan.
Okay.
From those things. But, here again, I'm 54. I've got plenty of 72-year-olds and 75-year-olds that are in plans with their required minimum distributions, helping them with long-term care, those things along the way. So, but here's the thing. There's companies out there where that's all they do. And so everybody that walks in the door is a nail because they've got a hammer, right? And there's been a lot of these policies that if they're not designed correctly, matter of fact, we've reviewed 3 this past week that weren't designed correctly, and our life team is flipping them over, redesigned them, and now it's going to work for them correctly and everything. We've actually saved them. So if you've got a policy and you haven't had it checked up, life insurance is actually, over the last 10 years, it's one of the things that have gotten cheaper because we're living longer.
I've heard that.
And so, yeah, any policy that's 10, 12 years old, you definitely got to come in and have it for a review because there's things we can do with it. We can either get you typically the same death benefit without paying any more money into it, just freeze it, or we can get you more death benefit if you want to continue to pay into it, or redesign it and help you build your cash value quicker.
Great. Yeah. All great information.
Yeah.
Any
other questions for you there?
You got me tonight, man.
Yeah, look, there's a lot more into this. We just scraped the surface tonight. But if you've heard of life insurance, using it for long-term care, not for death benefit alone, we definitely can help you out evaluate that, whether that's right for you. And that sort of a thing. What you want to do is you want to go to myfearlessretirement.com. That's all one word, myfearlessretirement.com. You'll see it right here on the screen. You'll want to go in, set up a time for you and I to have a 10, 15-minute discussion on the phone. We'll go through, we'll talk about it. We'll talk about our 5-step plan and then get you out the webinar so you can watch it and then come back and we can talk about it from there. So that's pretty much all I have.
Fantastic.
I want to thank you for joining us. Also, let's get back to the wine here. I know I've been taking some sips as we go through. What do you think? Now, what was the price point on this again?
$16.99.
Okay.
So not a bad price point. Not a bad price point.
Okay.
I have to be honest. It's not my favorite Josh Cellars.
Yeah.
There's a little bite to it at the end. I don't know if that's acidity or what.
Because you like other Josh Cellars?
I do.
Okay.
I do.
So you've had it and you like it.
It's one of our favorites.
So you thought you were really going to like this one?
Yeah. I mean, Family Reserve.
Yeah.
I mean, I can't buy into it. I'm going to have to give this one like a flat 3 corks, man.
Yeah, I think I'm going to be with you there on the 3 corks. I'm not a big fan of it either, especially at that price point. There's other price points that I know there of red wines that I've had, because I'd consider that kind of a table wine, at that point. And so I'm not a huge fan of it either. So now you don't have to spend your $16.99 on it because we spent ours on it.
Go.
So cheers, but
I think I spent mine, but
is that what it is?
Yeah,
That's okay. We'll leave it for Samantha and Jen in the morning, and they can take it home.
Well, cheers.
But I will finish my. I still have another sip, right? Absolutely. Cheers. Again, thanks for joining us. We'll see you next week with another topic. And again, 2 guys whining about retirement. It's the only place you're going to get a review on a bottle of wine and some great financial advice along the way. Hey, have a good week, and we'll see you next week. All right.